Hello there, Nick Vail here, as always, helping you live your best financial life. Today, I thought what I would do is kind of give some perspective and just some thoughts on what's going on in the stock market lately. Right, it's been pretty scary over the last few days for most. Right, I'm no different. It's never easy to open a statement or get into your portal and see red, right, and see drawdowns. So I thought I'd put some perspective to it, let you know just kind of how we handle things, and hopefully this is pretty helpful for you. So I put together a few graphics. I'm a visual learner, so I go with that. So let's start with the first thing being, and again, let me reiterate, I know it's not easy, and this is the hardest part about investing, right? But I think the big thing to remember here is that drawdowns in the market are a feature of investing. They're not a bug. So it's easy to forget that this is something that should be expected, right? And let's just look at some numbers as to what I mean. So 94% of years, investing years, right, since 1928 up until the end of last year, have seen a 5% or worse drawdown, right? And actually 5% happens 4.5 times on average per year. So this is actually to be expected. And again, I'm not trying to sort of belittle it. It's not easy, and I understand that it's painful to think about, and there's often that's all you're going to hear about on the news and on the radio and that sort of things. So I totally understand that it's painful. That being said, 10% drawdown or worse, 64% of years. So again, more often than not, large drawdowns happen at least once a year. And so it's important to just kind of put that into historical perspective, right? And not think that every single time it happens that this time is different, and to get overly concerned, right? So let's look at another kind of graphic. And I think this is important. This only goes back to 2009, but if we extrapolated this back to 1928, there's wars, all kinds of wars, all kinds of conflicts, all kinds of health scares that would play into it, and it looks just the same as this. So reasons to sell, right? And this is again with with S&P 500. So this may be a little bit hard to see, but you can see that every single year there's multiple quote unquote reasons to sell, right? There's going to be multiple crises in the world. There's always going to be some reason to scare us into thinking kind of the sky is falling, what do we do next? However, the overwhelming kind of trajectory that you see on this chart is that it goes up and to the right? The S&P is growing. And every single one of these items that you see on this chart, whether it be election years, which actually tend to be pretty good for the markets, and I know that's coming up and that's a big talking point, but even 2020, you see kind of the COVID issue, right? That was basically over 35% down overnight. It's very, very quick. You see that huge drop, and then what has happened since? Even what's going on in kind of the Israel-Hamas conflict, things have gone up and to the right since that even began. And so I think what the key point here is just that these things will always happen. So this time isn't necessarily different, right? There's always going to be some other crisis around the corner. The media will always spin it as a time to panic, because there's always going to be the want to get more viewers, and they're not going to share something like this with everyone that kind of alleviates concern, right? They want more concern. So I think that this is a good graphic that just shows there's always going to be some reason, some conflict that makes us think that now is the time to be selling and getting more conservative with your investments or moving to cash and that sort of thing. However, our overwhelming position is always to worry about the risk on the front end, right? If this is the type of, if it's 5, 10, 15% drawdown is something that will drastically kind of wreck your whole financial plan moving forward, then you shouldn't have been that aggressive in the first place. And that can be both monetarily on how much things fluctuate, but it also can just be personal to you. I don't really believe in a rule of thumb. If you're somebody that loses a lot of sleep over a 5% decline, then you probably should be much more conservative than anyone else invests. And that's not necessarily based on your age, right? That's just your personal behavior, how you sleep at night, what your mental health is going to be regarding markets. So again, we try to think about it as in terms of getting it addressed on the front end. And here's the two big things to consider, right? One, if you're young, this is why we always talk about, or you're kind of in that, I'll say, accumulation phase of your life. You're not at retirement yet. You're building assets. This is why cash is so important. I always say cash is kind of like the foundation of your home. You shouldn't be putting new siding and brand new windows and a brand new kitchen in a house that has cracks in the foundation, right? If you have, call it 3 to 8 months, whatever it may be, whatever, and when we work with our clients, it depends on kind of what their income and job situation is, but if you have a strong cash reserve, that is where you should be looking to during these sort of short-term tantrums in the market, right? As long as your day-to-day kind of spending is taken care of with the cash reserves, then you have more leeway to let your portfolios recover during these sort of market tantrums, right? If you're in retirement, what we do for our clients is we try to periodically put more money off to the side in cash for this exact same reason. It's similar to a cash reserve, but it's more money that you're drawing off of. So we're not strictly just taking a percentage off of your portfolio so that when it is declining, you're taking money off a declining portfolio, right? What we would do is park some of your assets in cash, call it maybe it's 18 to 24 months worth of income needed in cash, so that in cases like this, when there is a market correction, you're not trying to, I guess, catch a falling knife, if you will. So you have that cash already spoken for to the side, right? And you're funding your monthly expenses or annual expenses without having to worry about what's going on in the market. That way it gives you the ability to kind of wait out these corrections until they are back to break even and beyond, right? So quickly I'll go through another few. I think this is great. If you're one of our clients, you've probably seen this before. Quite frankly, investing 3 out of 4 years in general are positive, right? Now, of course, we need to expect that sometimes there will be negative years, and we haven't. We've been fortunate enough early this year that even though there is a pullback here, we started from a pretty good place. But I think this is a great graph that just kind of shows the intra-year declines, and then the red dots, and then the gray is where it finished for the year. So you could see that even in all these years over here, where you see positive returns, there was a lot of red down here. So and we looked at that kind of a chart at the beginning with how many drawdowns. I mentioned 4.5 times a year, you can expect a 5% drawdown on average. So even in all these years that ended positively, here, for example, you see a negative 14% drawdown, right? 27% increase, there was still a 5% drawdown. Now, of course, the opposite can be true here. But again, those are a lot fewer and further between. So again, the idea here is take it into perspective and take a step back. I know that it hurts when it's happening, but we have to remember that investing is not easy. And then lastly, let's look at this chart. This is a cautionary tale for timing the market. We always talk about time in the market being better than timing the market. And here's a quick example as to why. This represents if you invested $100,000 into the S&P 500, basically in 1999, and what has happened the 25 years since, right? I think this is pretty shocking to most. So if you simply missed the 10 best days, that's the difference between this number and this number. So $340,000 difference. 10 days, right, out of 25 years. Now, and of course it gets worse if you miss the best 20 days, best 30 days, et cetera, et cetera. So the key here is to remember that these days are often sprinkled in with the worst days. We don't know when the best days are going to happen in the market versus the worst days. So this is why we always say you should not try to time the market. It's about time in the market. And so the key here is to have a really strong plan and stick to it. Having cash reserves to handle these short-term tantrums in the market so that you're not having to pull money out of a declining portfolio. And really just to always remember to take a step back, look at the 30,000 foot view, and remember that these ups and downs in the market should be expected. They should not be looked at as a panic event each time they occur. So I hope this was helpful. Let me know your thoughts, and and hang in there. I know that it's difficult. It's never easy, but this too shall pass.